Welcome to the deep dive. If you're anything like us, the moment the IRS drops their new numbers for the next year, you get that feeling in your stomach.
A little bit of a clench, yeah?
Exactly. It feels less like helpful advice and more like a pop quiz you didn't study for. And it's written in, ancient Greek.
It is. The information overload is just immediate, and finding any real clarity in there is tough. But that's why we're doing this.
That's right.
We've spent the time going through all the official documents, really trying to crack the code on the critical 2026 numbers. We're talking tax brackets, contribution limits, the standard deductions.
And these aren't just numbers on a page, right? These are the rules of the game.
They absolutely are. They form the strategic framework that honestly determines your cash flow, your tax bill, and how efficiently you can even save for the next year.
So our mission today is really simple, and it's actionable. We want this to be a complete shortcut for you. The goal is that you walk away from this deep dive knowing the exact 2026 figures, but, and this is the important part, understanding the strategy behind them.
So levers you can actually pull.
The levers you can pull to legally save thousands of dollars. And we're talking specifically to you if you're a working professional, maybe earning between, say, $80,000 and $300,000 a year.
Because that's the income zone where these small strategic moves can have just massive payoffs.
Right.
And so we have to start with the big foundational question that drives this whole thing.
Which is?
Will these upcoming IRS changes, which are mostly just inflation adjustments, will they actually increase or decrease your taxes in 2026?
And I'm guessing the answer isn't a simple yes or no. It never is. It's not as simple as, oh, the deductions went up, so my taxes must go down.
Not at all. That's precisely right. The honest answer is, it depends. It depends entirely on your specific income and, more crucially, how well you manage that income to land inside the new 2026 brackets. Because while the brackets do expand a little bit for inflation, for many people in that sweet spot, the ones getting raises, maybe realizing some investment gains, your overall tax burden could still go up.
Because your income is growing faster than the brackets are expanding.
Exactly. Your income growth outpaces the bracket expansion.
Okay, so let's unpack this whole thing. Today, we're hitting 4 critical areas. We're going to start with the new standard deductions, and we'll analyze how much they actually save you.
Right. The real dollar amount.
Then we're jumping straight into the weeds, the exact income tax brackets. This is the structure that decides the true cost of a raise or a bonus.
Then third, we'll cover what you can control. The strategic points, those updated limits for your 401k, your IRA, and your HSA, and, how to think about prioritizing them.
And finally, we'll get into the advanced stuff, the nuances of capital gains taxes. This is often where high earners make some of the most expensive, but also the most avoidable mistakes.
And they all work together. You can't really optimize one without understanding the other 3. So let's start at the very beginning, the easiest number to wrap your head around.
All right, let's start with that baseline then. The standard deduction. For most people, this is the amount of income that is just, poof, shielded from federal tax right off the top.
Yep, before you even start calculating brackets.
So for the huge majority of taxpayers who don't itemize, this is really the first number that sets the stage for your tax bill in 2026.
It absolutely is. Think of it as like the universal floor for your tax calculation. The IRS tweaks these numbers every year, mostly for inflation, which means, in theory, a little less of your income is subject to tax.
Which is always nice.
It's a welcome change, for sure. But the strategic importance of the standard deduction, especially for higher earners, I think it's often way overestimated.
Okay, so let's put the exact numbers on the table because this is the foundation for any planning. For single filers in 2026, the standard deduction is moving up to what?
It's going up to $16,100.
So $16,100.
Right, and that increase is about $350 compared to 2025.
Okay. And what about for married couples filing jointly? That's the scenario for a lot of the dual income households we're talking to.
For them, the deduction is now $32,200.
It's $32,200.
Yep, and that's an increase of $700.
And for head of household filers, they see a similar kind of bump, right? An increase of about $525.
That's right, a proportional increase.
Now, when you look at that $700 increase for a married couple, on paper, that sounds pretty good. People see the headline, $700 more deduction, and they probably feel a little sense of relief.
They do, and you have to acknowledge every single dollar of deduction is a good thing. But when you really drill down and analyze that increase, you realize it's only about a 2 to 3% bump across the board.
So it's basically just keeping pace with inflation.
Exactly. It's not the kind of change that's going to dramatically alter your financial life. It's really just noise compared to the signal from the tax brackets.
This is where that perspective is so critical. Let's translate that deduction increase into actual real-world dollars saved, because a deduction only saves you tax at your highest tax rate, right? Your marginal rate.
This is the key insight. People often get this confused. They think a deduction is a dollar-for-dollar reduction in their tax bill, and it just doesn't work that way.
Right.
So let's take that married filing jointly increase of $700. Most of our audience, making over $100,000, they're going to be in at least the 22% marginal tax bracket.
Okay, so if that $700 deduction is only saving you money at a 22% rate, what's the actual tax savings? What's the number?
The math is simple. It's just 22% of $700, which comes out to exactly $154.
$154. Wow. Okay, that really puts it in context. $154. I mean, look, it's money you wouldn't have had otherwise, but that perfectly shows why just relying on the standard deduction change is not a strategy.
It isn't. It's a small comfort, but it's not the leverage point.
Not at all.
And it confirms two things for me. First, these yearly adjustments from the IRS are, they're incremental, almost negligible for big picture planning. And second, it just reinforces why the structure of the tax brackets themselves matters so much more.
Because that's what determines how valuable every single dollar is.
Exactly. Every dollar of income and every dollar of deduction.
So it really sets the stage for why you have to be proactive about managing your taxable income, because the IRS is only giving you a tiny little break at the starting line. The real game is played in the middle of the field.
Which leads us directly to the framework that governs everything else.
Okay, so now we're moving into what is probably the most critical part of this, the 2026 marginal income tax brackets. If you tune out everything else, at least pay attention to these thresholds we're about to go through.
And remember the key definition here. These brackets apply to your taxable income.
That's a huge distinction. Taxable income, not gross income.
For our audience, this is often where the confusion begins. Can we just quickly clarify that path from the total money you earn to the money that actually gets taxed?
Absolutely. So you start with your gross income. That's everything. Salary, bonuses, any RSUs that vested, investment income, all of it.
The whole pile.
The whole pile. Then you subtract what are called adjustments, things like your contributions to a traditional 401k, maybe some health insurance premiums, stuff like that. That gets you to your adjusted gross income, or AGI.
And AGI is a really important number.
It's a critical number. It's the gatekeeper for eligibility for a lot of tax credits and other strategic accounts.
Okay, so from AGI, what's next? From your AGI, you then subtract either your standard deduction, which we just covered, or your itemized deductions if you have them. And whatever is left after that final step, that is your taxable income.
That's the number the IRS uses to figure out where you land in these brackets.
That's the one.
Perfect. Okay, let's lay out the exact numbers for 2026. Since so many people in our audience are in that high-earning household range, let's start with married filing jointly and just take it slow.
Sounds good. So for married couples filing jointly, here is the structure for 2026 taxable income. The 10% bracket is very compressed. It only applies to income from $0 up to $24,800.
Pretty small.
Very small. Then the 12% bracket kicks in, and that runs from $24,801 all the way up to $100,800.
Okay, so $100,800. That's a big first threshold. Once your taxable income crosses that line, your very next dollar gets taxed at 22%.
Precisely. And that 22% bracket is, it's one of the most common for dual income households. It runs from $100,801 up to $211,400.
And then the next jump is pretty significant. The 24% bracket starts at $211,401 and goes all the way up to $403,550.
Right. And this is the bracket that a huge portion of our target audience lives in. But it's also, where the danger zone begins.
After that, we start seeing those major tax cliffs.
We do. The 32% bracket starts at $403,551, and it runs up to $512,450.
And above that?
Above that, you got the 35% bracket, which is between $512,451 and $768,700.
And then finally, the top rate.
The top 37% bracket applies to any taxable income over $768,701.
Okay. Now let's quickly run through the single filer numbers because the thresholds are so much lower. That tax cliff can hit a high-earning individual much, much faster.
It really can. For single professionals, the 10% bracket is just $0 to $12,400. The 12% bracket goes from $12,401 up to $105,700.
And that $105,000 mark is huge for single professionals. A lot of early career high earners land right there.
You do. And that jump immediately puts their next dollar into the 24% bracket, which runs from $105,701 up to $201,775.
And then comes the next major cliff for singles.
The 32% bracket. It starts at $201,776 and goes to $256,225. And just notice how much lower that is than the married threshold.
It's a huge difference.
The higher tiers follow from there. 35% is $256,000 up to $640,600. And then that highest 37% rate kicks in for anything over $640,601.
So those are the hard numbers. Now for the real insight, the sources say the bracket's expanded by about 3% over 2025. That sounds good. You can earn a bit more before you jump.
Yeah.
But you said earlier this often doesn't cancel out the higher overall tax burden. Why is that?
Well, it's because most people in this demographic are growing on multiple fronts, right?
Yeah.
You're getting salary increases, promotions, and this is the big one. You probably have a successful investment portfolio that's throwing off dividends and gains.
Right.
The bracket expansion is designed to fight inflation. It's not designed to account for your personal income growth. So if your income grows by, say, 5%, but the bracket only expands by 3%, that extra 2% of your income is now being taxed at a higher marginal rate than it was last year.
And that's the insidious nature of bracket creep.
That's it, exactly.
And for people earning in that $250,000 to $300,000 range, there's a specific danger zone we need to focus on, that 32% threshold warning.
Let's use the married filing jointly example, where that 32% bracket starts at that huge number, $403,551 in taxable income. A household earning, say, $280,000 might look at that $400,000 number and think they're totally safe.
Yeah, they think, I've got over $100,000 a room.
Exactly. I've got plenty of buffer. And, if you just look at their base salary, you can see why. If a couple earns a stable $260,000 base, even after you subtract the $32,200 standard deduction, their taxable income is only around $227,800.
Well, within the 24% bracket, no problem.
But this is the hidden trap. And it's probably the most common mistake made by this specific audience, especially folks in tech or at large corporations. Their base salary is just one piece of the puzzle.
Okay, so let's build it out. You have that $260,000 household. What else comes in?
Well, maybe they get a $50,000 performance bonus.
Okay, so that's $310.
And then they have, say, $60,000 in restricted stock units, or RSUs, that vested. That's treated as ordinary income.
So now we're at $370,000.
And maybe they realized another $20,000 in dividends or other investment gains earlier in the year.
So their gross income just shot up from $260,000 to $390,000.
Exactly, $390,000.
Yeah.
Now, subtract their $32,200 standard deduction, and their taxable income is around $357,800. They are still in the 24% bracket, but they're getting dangerously close to the edge.
Wait, but how are they flirting with the 32% bracket? That starts at $403,551. They still have a buffer of like $45,000.
But this is where the contributions come in. If that household hasn't been aggressive about maxing out their pre-tax 401ks, or if they prioritize Roth contributions, which don't reduce their immediate taxable income, they're super vulnerable.
Okay.
So now imagine it's a good year and they decide to sell some stock to realize a $50,000 gain for a down payment, and they hadn't held that stock for a full year.
Short-term capital gains, taxed as ordinary income.
That's it. So that $50,000 short-term gain gets added right on top of their $357,800 taxable income, pushing their total over $407,000.
And just like that, they've crossed the $403,551.
They've officially crossed it. Every single dollar over that threshold is now taxed at 32%.
And that jump from 24% to 32%, that's an 8-point jump. It fundamentally changes the math on that last $50,000 of income.
It absolutely does. It means the value of that last bonus dollar or the last dollar you earn from a side project is just severely diminished. This is why knowing where those bracket lines are is so critical.
Because it determines the real value of a raise, how much of your bonus you actually keep, and how effective your contributions are.
And it makes it crystal clear that for this audience, managing your adjusted gross income through contributions is the key to staying in control. You have to create enough deductions to pull that big compensation package back down out of those higher marginal brackets.
And that's our transition point. We have to shift from what the IRS mandates, the brackets, to what you, the listener, can actually control. So we've established the 32% bracket is this major financial hazard, especially for those high-earning households getting RSUs and big bonuses. Now let's talk about the levers. What can we actually pull to reduce our taxable income and strategically stay out of that danger zone?
This is the optimization section. It's about maximizing your contributions to your 401k, your IRA, and your HSA. It's simple, really. Every dollar you put into a traditional tax-deductible account is a dollar that doesn't get pushed into that 32% or 24% bracket today.
Let's start with the biggest, most powerful tool available to most professionals, the workplace retirement plan. Your 401k, 403b, or 457b.
Well,
What are the specific actionable limits for 2026?
for employees under the age of 50, the maximum you can contribute yourself in 2026 is a huge number, $24,500.
$24,500.
Yep, this is the first place our audience should be looking. It gives you an immediate dollar-for-dollar reduction of your taxable income.
And for those 50 and over, recognizing that people often ramp up their savings later in their careers, there's a catch-up contribution.
A substantial one. It's $8,000.
Wow.
And if you look at the total picture, including an employer match and maybe some profit sharing, the total maximum combined amount that can go into your account in 2026 is $72,000 for someone under 50.
That just shows you how much income can potentially be shielded from tax in the current year.
It's a massive shield.
So let's talk strategy. For a client in that, say, 180 to 250,000 household income range, how do you decide between contributing to a traditional pre-tax 401k or a Roth post-tax 401k?
This is the classic dilemma for high earners, and it really all hinges on one thing: trying to predict your future tax rate.
Which is impossible, but you have to try.
You have to make an educated guess. If you're currently in the 24% or 32% marginal bracket, the argument for the traditional 401k is, frankly, overwhelming. You are saving 24 cents or 32 cents on every single dollar you contribute today.
And that reduction not only saves you tax now, but as we just discussed, it helps keep your other income out of the next highest bracket.
Exactly. It's a bracket management tool. The Roth 401k is generally better for people who are in a lower bracket right now, maybe 12% or 22%, but they have a strong reason to believe their income and tax bracket will be much higher in retirement.
So for most of our audience fighting against those 24% and 32% cliffs, traditional is the tactical priority.
I think so, yes. It's an immediate taxable income reduction strategy.
That's a vital distinction. Okay, moving beyond the workplace plan, let's look at IRAs, individual retirement accounts. What are the 2026 contribution limits there?
The IRA contribution limit for 2026 is $7,500 for those under 50.
$7,500.
And the catch-up contribution for those 50 and over is an additional $1,100.
Now, this is where we have to get into a really important nuance: the income phase-outs for deducting a traditional IRA. Our audience is right in the middle of this zone.
This is critical because it determines whether a traditional IRA gives you any tax savings today. If you or your spouse have a workplace plan like a 401k, you start losing the ability to deduct your traditional IRA contributions once your modified AGI hits certain levels.
And what are those levels for 2026?
For a single filer who has a 401k, the deduction starts phasing out around 83,000 MGI and has gone completely by about 98,000.
Okay.
For a married couple filing jointly, that phase-out range is about $138,000 to $158,000.
Wait, 158,000 MGI for a married couple that's pretty low. That's easily hit by a single high earner, let alone a dual income household.
It is very low. And what it means is that for a huge portion of our target audience, those dual income households earning over 160K direct contribution to a traditional IRA usually gives them zero tax deduction.
So it's strategically useless for reducing your current taxable income.
That's right.
And that leads us directly to the advanced technique, the backdoor Roth strategy. Since most high earners are blocked from contributing directly to a Roth IRA because of income limits, how does the backdoor Roth fit into our 2026 plan?
The backdoor Roth is absolutely essential for high earners.
Yeah.
The income limit to contribute directly to a Roth is fully phased out above $240,000 for a married couple. So you have to use this mechanism.
The workaround.
It's the workaround. You contribute non-deductible money to a traditional IRA, and then you immediately convert it to a Roth IRA. The great thing is that annual contribution limit of $7,500 still applies, so it allows high earners to get money into that tax-free growth Roth environment, even though their income is too high for the front door.
It's what keeps the Roth dream alive for them. So the common order of attack for a high earner professional should probably be something like 1, max out the 401k, probably traditional. 2, max out the HSA. And 3, execute the backdoor Roth.
That is an excellent summary of the priorities. And that brings us to number 2 on your list, which is maybe the most powerful account for maximizing tax savings in that 120 to 300,000 income range, the health savings account, or HSA.
Why does the HSA get such high praise?
Because it's the only mainstream account that has what they call the triple tax advantage. Most accounts give you 1 or 2 tax breaks. The HSA gives you 3.
Let's detail those 3 advantages again just for emphasis.
Okay, so first, the money is tax deductible going in,
Yeah.
just like a traditional 401k. So it reduces your AGI, helps you fight bracket creep.
Got it.
Second, the money is tax deferred while it's growing. You don't pay any tax on interest, dividends, or investment gains inside the account.
And the third one, the real game changer.
The money is completely tax-free when you pull it out and use it for qualified medical expenses, now and in retirement. And here's the kicker. Once you turn 65, you can withdraw the funds for any reason without a penalty. It's just taxed as ordinary income, like a 401k. But if you use it for medical costs, it's tax-free forever.
That is immense power. Okay, we need the 2026 limits for the HSA.
For individual coverage under a high-deductible health plan, which is required, the HSA limit is $4,400.
Okay.
For family coverage, the limit jumps way up to $8,750. And there's a catch-up contribution of $1,000 for those 55 and older.
That $8,750 is a huge chunk of tax-deductible income. If a married couple each maxes out their $24,500 401k and then they add the $8,750 HSA, they've potentially removed over $57,000 from their 2026 taxable income.
And that is the kind of leverage you need to fight back against that 32% danger zone.
Absolutely.
And we should touch on the advanced strategy for the HSA, the stealth retirement account.
Right. This involves paying your medical bills out of your own pocket today and just letting the HSA funds grow, correct?
That's the core idea. The big mistake is using your HSA like a checking account for every doctor's visit. If you could afford to pay those bills with your cash flow today, you should. Then you keep careful records, receipts, for all those qualified medical expenses. The receipts never expire.
And you invest the HSA funds?
You invest them aggressively. Then, decades from now, when you retire and you need tax-free income, you can reimburse yourself for all those accumulated decades-old medical receipts, pulling out all that growth completely tax-free.
So you basically turn the HSA into a completely tax-free emergency fund or retirement supplement just by being disciplined about tracking receipts today.
It's a deferred tax-free reimbursement. It maximizes that triple tax advantage by letting everything grow untouched for decades. This is what separates a passive saver from a really strategic wealth builder in this income band.
Okay, we've hit on income, we've hit on contributions. Let's tackle the third major piece of this puzzle, which is where your investments and your wealth generation crash into the IRS. Capital gains taxes. Most people get that profit is a gain, but the mechanics of how it's taxed are confusing. And that confusion leads to huge tax bills.
It really does. Capital gains are the engine of wealth, but they have their own completely separate, complex tax code. If you bought a share of an index fund for $100 and you sold it later for $300, that $200 profit is your capital gain. The complexity, like you said, is because the tax rate you pay on that profit depends on 2 critical factors.
Well, what are those 2 factors?
First is how long you held the asset. That determines if the gain is short-term or long-term. And second is where your ordinary taxable income lands within the special capital gains thresholds.
Okay, let's break down the holding period first. Short-term versus long-term.
If you hold an investment for less than 1 year, it's a short-term capital gain. This is the worst-case scenario from a tax perspective, because short-term gains are taxed just like ordinary income. That $200 profit gets lumped in with your salary and gets hit with your standard marginal rate.
Yeah.
22%, 24%, 32%, whatever it may be.
So if you're a single professional already in the 32% bracket and you sell a stock that appreciated quickly, you're handing 32% of that profit straight to the IRS. That's a massive drag on your returns.
It's a huge disincentive for short-term trading. But if you hold that investment for more than 1 year and 1 day, it qualifies as a long-term capital gain, and the tax rates are dramatically lower.
The government rewarding patient long-term investors.
That's the idea.
So let's lay out the precise 2026 long-term capital gains brackets. These are the thresholds that determine the actual rate on your investment profit.
Okay, for married couples filing jointly, the 0% tax rate applies if your total taxable income is up to $98,900.
0%. That's powerful.
It's incredibly powerful. Then the 15% tax rate applies for the income range above that $98,900 all the way up to $545,500.
A huge range.
A very wide range. And then the highest rate, the 20% tax rate, applies to anyone with taxable income above that $545,500 mark.
Okay. And for single filers with their lower thresholds?
For singles, the 0% tax rate applies to total taxable income up to $49,450.
$49,450.
The 15% rate then applies for the range above that, up to the same $545,500.
And the 20% rate also kicks in for anyone above $545,500.
Now, that 20% rate is important for anyone who might have a big liquidity event, right? Like selling a business or a house.
Exactly. It's not something our core audience might hit every year, but if you have a big sale, you need to know that 20% rate is lurking up there.
But for the day-to-day investor in our target range, it's really all about that 0% and 15% threshold. And this brings us to the stacking rule, the single most misunderstood concept in capital gains.
It truly is. People see 0% capital gains, and they just assume they can cash out 50 grand worth of stock tax-free. And that is a very dangerous assumption.
So let's use the bucket analogy. Explain how the buckets fill up. Okay, your ordinary income, your salary, your bonuses, your vested RSUs, that fills up the tax bucket first. That income is taxed at your regular marginal rates, 10%, 12%, 22%, and so on. Only after all of your ordinary income has found a home in those brackets does your long-term capital gains sit on top of all of that.
So the amount of your salary is what determines where your capital gains tax journey begins.
Exactly. Let's use a specific example. A married couple, their taxable salary, after all their deductions and 401k contributions, is $110,000.
Yeah.
And they want to sell some long-term stock to realize a $50,000 gain.
Okay, so their total taxable income is $160,000. Where does that capital gain land?
That gain automatically starts getting taxed at the 15% rate.
Why?
Because their salary of $110,000 already blew past the 0% capital gain threshold, which ends at $98,900 for married couples. Their salary filled up all the ordinary income brackets up to $110K. So the $50,000 capital gain has to sit on top of that, which puts it squarely in the 15% long-term capital gain zone.
That is such a critical distinction. And on the flip side, if that same couple strategically used their 401ks to get their taxable salary down to, say, $95,000, just under that $98,900 threshold,
then they could realize $3,900 in long-term gains at that beautiful 0% rate before the 15% rate kicks in.
that is the power of synergy. You use your 401k to manage your ordinary income, which in turn allows you to strategically harvest capital gains at a 0% rate.
That is advanced tax planning right there. You are timing your sales based on the marginal tax thresholds that you created with your own contribution.
Which also means that tax loss harvesting selling losers to offset gains is strategically vital here.
Absolutely. It's an active management tool to keep your overall gains in a lower bracket. And finally, let's just reiterate the key difference. Realizing long-term capital gains does not raise your ordinary income tax bracket.
Okay.
But your ordinary income tax bracket absolutely determines the rate at which your long-term gains get taxed.
So if I realize $100,000 in long-term gains, I might pay 15% on that. But that sale won't cause my next dollar of salary to jump from the 24% to the 32% bracket.
Correct. They run on parallel tracks, but the ordinary income track dictates the starting point for the capital gains track. Understanding that is essential for any year-end strategic selling.
Okay, we have covered a ton of ground today. From the small comfort of the standard deduction all the way to the huge strategic moves you can make with contribution limits and capital gains. Let's try to synthesize this and give you a final cohesive summary.
It really comes down to 4 specific interconnected levers that determine your financial outcome in 2026.
4 levers.
That's right. And now you have the specific 2026 numbers for them. First is your income tax bracket. You have to know precisely where those 24% and 32% cliffs are.
Right, because that determines the real cost of earning your next dollar, especially from RSUs and bonuses.
Second, your deductions. The baseline, that $32,200 for a married couple that shields your income. It's the starting point, even if its impact is small.
Okay, third.
Your retirement contribution strategy. Your 401k, IRA, and HSA. This is your main control panel. Use that $24,500 401k limit and the $8,750 HSA limit to aggressively lower your taxable income.
And stay out of those higher ordinary brackets.
And fourth, your capital gain timing. You have to master that stacking rule. Time your sales to make sure your long-term profits are taxed at the lowest possible rate. Ideally, you use that 0% bracket if your AGI allows for it.
So by actively pushing down your AGI with those big traditional contributions, you get a 2-for-1. You minimize the tax on your salary and bonuses, and you also lower the starting point for your capital gains taxes.
It's about making your money work harder for you, not just you working harder for your money.
And this knowledge is really the key to legally keeping thousands of dollars in your own pocket without needing a raise or changing jobs.
It is. Most people are going to wait until March of 2027 to even think about their 2026 taxes,
Yeah.
and then they'll realize they overpaid.
Yeah.
But you're here now. You have the exact 2026 numbers, and you have the strategic roadmap.
That is proactive financial management. And on that note, we'll leave you with one final thought to think about. Since so many high earners are always navigating that border between the 24% and 32% tax brackets, and since their income usually excludes them from direct traditional IRA deductions.
The complexity and the necessity of the backdoor Roth strategy only intensifies.
So what's the specific thing to mull over?
You have to consider the pro rata rule when you execute that backdoor Roth, especially if you have any existing pre-tax traditional IRA balances from, say, old 401k rollovers. Integrating this new $7,500 IRA contribution limit requires very careful planning around that specific rule to avoid an unexpected tax bill on the conversion.
Absolutely. The devil is always in those details, and the rewards are always in the planning. Until next time, keep optimizing those numbers.